Good morning, everybody. Welcome back to the class Investment and Portfolio Management. This week is the week number 9 that I want to introduce you to have the idea of the investing in fixed incomes. There are two subtopics of the week 9, investing in fixed incomes. The 9.1 is the fixed income security, and the part 9.2 is the bond valuations. This topic is necessary when you make any investment decisions, investing in bond or the fixed income, including any mutual funds with their investment policy in fixed income security. The learning objective of the PowerPoint number 9.1 is understanding the basic concept of the fixed income security here as the first bullet point. After we completed this chapter, right? Firstly, I expect you understand as the first bullet point. I expect you interest the nature of the fixed income security. And the second learning objective here is that I expect you can classify the type of the fixed income security. And for example, treasury bills is the kind of the fixed income security, government bonds, corporate bond, or any like a hybrid fixed income instruments. Thirdly, as the learning objective, the third learning objective here, I expect you have you understand, right? You have the idea that what are, right, benefit of investing in fixed income securities. And here for the fourth learning objective, what I expect from you. I expect you, right, can calculate the return, right, of the fixed income investment. And the last learning objective, that is the risk-related fixed income investment. So I expect you as the last learning objective as the number 5 of the learning objective here. I expect you can describe the risk-related fixed income investment. Here, because of the learning objective of the previous slides, bring you, right, to here as the content here the detail that I want to share you the idea of the first one, fixed income characteristic. Second one is the type of the fixed income security. The third one is the benefit of investing in fixed income security. And the last one, risks related to fixed income investment. And here, shall we start with the first one? The topic should be the fixed income, right? Fixed income characteristic. What is the fixed income here? What are the fixed income security? You can notice here from this slide that the fixed income security is a kind of the financial security. The main characteristic of the fixed income security is that fixed the periodic payment as the second bullet point, fixed periodic payment. So I will repeat what I expect you, right? I want to share you the idea that what are fixed income security here. Fixed income security is a kind of the financial asset or the financial security that pay the investor. You are the investor, right? That pay the investor as the second bullet point, that pay you the fixed periodic payment, right? That is the fixed periodic interest. When you invest in any kind of the fixed income security, your status is creditor. As the third bullet point, you are the investor, right? Your status, you are the creditor. You are the creditor. Okay, here the issuer, right? The issuer of the fixed income are borrower as the fourth bullet point. The issuer is the borrower. For example, can you imagine, please follow me here, that for example, you invest in a government bond for 3 years, right? You are the creditor of government, right? In case you invest in the 3 years corporate bond, for example, you invest in the corporate bond of the SCC, Siam Cement Public Company Limited, right? Which a large firm here in Thailand. So in this case, You are the creditor of Siam Cement Public Company Limited, right? In this case, as I give you the example here, that the government and the Siam Cement Public Company Limited are borrowers, right? Are borrowers, and you are the investor who invest or who buy the government bond or the corporate bond of the Siam Cement or the SCC. You are creditor. The borrower, right? The borrower promised you, right? Promised you as the investor, they will, right? They will pay you the periodic interest payment as the coupon, 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 right? During the 3 years and the principal at the end of year 3, right? At the end of year 3, as the bullet point number 5 and number 6. Okay, here at this time, you have the concept of the characteristic of the fixed income security. Then I want to share you. I would love to introduce you to have the idea, to have the concept of the timeline investing in fixed income security as the slide number 6. For example, Miss Ploy, right? Miss Ploy, she invests in the Siam Cement bond, right? She invests in the Siam Cement bond with the tenor. Tenor is mean that the holding period, right? The holding period is the 3 year. SCC, right? The Siam Cement commit the investor commit Ploy that the SCC, the Siam Cement will pay the investor 3.5% per year at the end of each year. So in this case, please notice here that at the beginning of the period, saying that the year zero at the beginning of the period, when Ploy invests in the SCC, when Ploy invests in the Siam Cement bond, she need to pay out, right? I mean the cash outflow. Please notice here that the cash outflow should be minus 1,000 baht in this case, right? At the beginning of the period. I say again that at the beginning of the period, at the year zero, right? At the year zero, it means that the beginning of the period. Miss Ploy, she pay, P-A-Y, right? P-A-Y-S, she pay minus 1,000 baht, right? And then she will get paid, right? She will receive, she will earn the return. I mean the coupon payment from the SCC at the end of year 1, she get 35 baht, and at the end of year 2, she earn 35 baht, and as well at the end of year 3, right? She still get the coupon payment at the 35 baht, as well as at the end of the year 3. Miss Ploy, she will get her principal, right? She will get her principal. Here that is the cash flow, right? The cash inflow and the cash outflow. At the beginning of the period should be the cash outflow. You need to put like a negative or the minus 1,000 baht. During the year, you get the coupon payment at the end of year 1, at the end of year 2, and at the end of year 3. And at the end of year 3 as well, right? The investor will get that principal at the end of year 3. I mean that at the end of the maturity date. Here, in terms of the type of the fixed income security, may I introduce you to have the idea, the basic, right, the common type of the fixed income security. First one should be T-bill, treasury bills. Second one should be government bond, and the third one should be the corporate bond. Let's see what it is, right? What are the characteristics? What is the characteristic of the first type, that is the treasury bills? Here you are the characteristic of the treasury bill. What is a treasury bill? Please notice here on this slide that the treasury bill is the kind of the short-term debt. Short-term debt, right? What are the short-term debt? So the time, right, the period of the short-term debt. Please notice at the second bullet point that the maturity of the treasury bill should be, right, 1 year or less than 1 year. It might be 6 months, 9 months, or 1 year, but should not be more than 1 year. And then for the third characteristic of the T-bill, the third characteristic of the Treasury bill, that is, this kind of the fixed income should be issued, right? ISSUED, issued and backed by government, backed by government. In this case, in the term of the Treasury bill as well as the government bond, right? The issuer should be government, right? Who is the government? Here in Thailand context, the government should be the Ministry of Finance. For the fourth bullet point here, the risk-free asset, risk-free asset. What does this mean? Because you can notice here that on the third bullet point that the Treasury bill issued and backed by government, right? So in this case, in Thailand, as the Thailand context for the Treasury bill, that is that we call here like a risk-free asset because government back this fixed income security, that is the Treasury bill. And the third and the fifth one, the characteristic of the Treasury bill here is that the Treasury bill or the T-bill during the period, it might be 3 months, 6 months, 9 months, or not more than like 1 year. During this period, you will not, right? You get nothing. I mean, you get no coupon payment from this investment. So the T-bill, the Treasury bill, pay no coupon as a form of, we call here as the zero coupon debt, right? Zero coupon debt. And then like what are the return? What is the return that you are the investor? You invest or you buy the Treasury bill. The return or the yield that you get from the Treasury bill is that because the T-bill, right, the T-bill sold to the investor at the discount rate, as the discount rate. Let's see what is the discount rate. I introduced you to have this timeline, right? To have this timeline that this is the investing in the Treasury bill. So here in this case, okay, please imagine that you are the fund manager, you are the portfolio manager of an asset management company. You're responsible for a money market mutual fund, right? You are the portfolio manager. You invest, right? You're responsible for a money market mutual fund. You invest, right? You invest this fund. I mean the money market fund invest in the T-bill, the Treasury bill. Tenor, right? Tenor is the range, the holding period of the T-bill is the 180 days. Please notice here that 180 days is less than 1 year, right? Less than 1 year. Please notice here that at the beginning of the period, at the day zero, right? Day zero, you invest, you pay the money. Please notice here that should be the cash outflow minus 89,000 baht, right? 89,000 baht. Assume that this money market fund invest, right, in the T-bill on 1st of January 2020, right? This fund pay, right, minus 98,000 baht. And then during the 180 days, right, from day zero until day 180, this mutual fund get nothing from this investment, right? But at the end of the period, I mean at the end of the day 180, this mutual fund, this money market fund will get, right, will get 100,000 baht, right, 100,000 baht. So here we call Treasury bill as the discount, right, as the discount, as the zero coupon debt. The return that the fund, that mutual funds, or the return that the investor will get or will earn is the differences between what? Between the money that you pay at the beginning of the period and the amount that you will get at the end of the period. So how to, right? How to calculate. Okay, here in this case, the discount rate. I repeat again that this is the cash flow, right? At the beginning of the period day 0, you pay minus, right? You pay minus 98,000 baht as the cash outflow. You wait until the day 180, you will get, right? You will get the money 100,000 baht. So how to calculate the discount rate? So you can apply both formula as well. The first formula, discount rate, face value minus purchase price divided by face value multiplied by 360 days divided by the number of days to maturity. Or you may apply the second, right? The second formula, discount rate as well. You apply the ending value divided by beginning value minus 1, then multiply by 360 days and divided by the number of days to maturity. Okay, you should memorize, right? You should memorize that the example that I give you as the treasury bill here. Again, the same money market fund. So how to calculate the discount rate that the money market fund earn or get from that investment? I mean, invest in the treasury bill. So in this case, right, at the end of the period, right, at the end of the period, I mean, right, at the end of the day 180, the mutual fund get 100,000, right? They divided the 100,000 baht by beginning value. At the time, at the day 0, the mutual fund pay, right, the cash outflow at the 98,000 baht. Then you apply 100,000 baht divided by 98,000 baht minus 1 multiplied by 360 days divided by 180 days. You will get the return, right? You will get the discount rate. You will get the yield of that investment. In this case, you will get the number that is the 4.8%. Here, I already complete, right? I already give you the idea of the treasury bill. Then, shall we go to the next, right? The next type of the fixed income, that is bonds, right? Bond. What is the bond? The second type of the debt security or fixed income security is bond. Okay, what are bonds? Bonds are the financial security that allow governments or any company or corporate to raise money as the debt or loan from the investor like you, right? So government or the company who issue the bond will pay you the interest probably every 6 months or every year, right? And will return you the principal at the maturity date, right? So in terms of the bond, right? In terms of the bond, there are the common types of bond I would love to introduce you. First type should be the government bonds. The second type should be the corporate bond. Here, may I introduce you to have the idea what is the government bond? So in this case, the government bond is the debt security, right? It's the debt security. The main characteristic of the government bond is that the government bond issued by government. Who is the government? In the Thailand context, right? In the Thai context, the government here is the Ministry of Finance. The purpose, right? The objective, right, of the government bond is that the government lends the money in order to support the government spending. Here, the characteristic, right? The characteristic of the government bond. Firstly, the government bond pay the investor periodic interest payment or coupon. And then the government bond, right, will return the principal to the investor at the end of the period, I mean at the maturity date. And then for the third bullet point, the characteristic of the government bond is that low risk investment compared with corporate bond, because the government back right? The government back the government bond. And then because of the lower leaks, right? Then the government bond compared with the corporate bond. The government bond normally pay the lower interest rate or the lower coupon compared to the corporate bond. Okay, here in terms of the cash flow, right? In terms of the timeline, in terms of the cash flow, in this case, right? You are the investor, right? You invest in the bond with the tenure of the 5 years with commit of paying a coupon 2.5% per year at the end of the year, at the end of each year. So please notice, right? Please notice the timeline that at the beginning of year one, right? At the beginning of year one, you invest. So please notice here that should be cash outflow negative, right? Or minus 1,000 baht. Here you are at the end of the year one, at the end of year 2, 3, 4, and 5. You will get the coupon 25 baht. And as well at the end of year 5, you will get your principal 1,000 baht, right? 1,000 baht. That's all in terms of the government bond. I already introduced you to have the idea what is the government bond, right? And here, shall we move to the next type of the fixed income? Next type of the bond, that should be the corporate bond. What is the corporate bond here? What is the corporate bond? So the corporate bond, right? The corporate bond is the kind. The corporate bond is the type of the debt security, right? But in this case, in terms of the corporate bond issued by a company, right? By a company. For example, the company is might be SCC, Siam Cement, or the AIS, the S1 Info, or the CPO, right? So here, this that I named, right? The company that is the name of the corporate that probably and can issue or launch the corporate bond. And here the objective, right? The objective of the corporate bond, the company or the corporate launch or issue a corporate because they want to show to the investor and will distribute this money to their business, right? So here the price and interest, right, offer to the investor depend on the company financial stability and creditworthiness, right? Bond with higher grade, right? I mean that bond with higher credit rating tentatively, right? Tentatively pay lower coupon rate. Okay, let's see here. The characteristic of the corporate bond. Firstly, right, I introduced you to have the idea, the concept of the corporate bond characteristic, that is the corporate bond issued by a company. Normally, the corporate bond is like a riskier than government bond. And then because of the risks, right? Because of the risks that the corporate bond is riskier than the government bond, right? Then the corporate will offer the investor higher coupon or the higher interest rate compared with the government bond in order to compensate this additional risks, right? Here, that is the characteristic of the corporate bond. On this slide, right? On this slide, I show you the example when you invest in the corporate bond. In this case, right? In this case, the investor invests the PTT, right? The PTT bond with the tenure of the 3 year, which commit to pay the coupon at 3%. So my annually payment, right, might be in June at the mid-year and at the end of the year, December of the year. So firstly, at the beginning of the period, the year 0, you pay that as the cash outflow. Please notice here that minus 1,000, right? Here at the end of the June, right, mid-year, at the end of June, you get 15 baht, end of December, 15 baht, end of June, end of December, end of June of the year 3, and end of December of year 3. You get the coupon, right? You get the coupon payment 15 baht. And at the end of the maturity date, that is the end of the year 3, you will get back your principal, 1,000 baht, you get back your principal. Here, in terms of the corporate bond, there are some kind we can categorize the corporate bond as well. So firstly, the corporate bond can be categorized based on the credit quality, based on interest payment, based on convertible or option, based on the collateral, and based on the maturity. Firstly, I will introduce you that the corporate bond that be categorized by the credit quality. That should be the investment grade bond and non-investment grade bond. What is the investment grade bond, right? In terms of the investment grade bond, this kind of bond are issued by company with higher credit rating. What is the higher credit rating? Credit rating, BBB minus or better, right? For example, the AAA, double A, single A, or the triple B, right? Here, this is the credit rating, the investment grade bond. So this kind of bond, right? This kind of bond contain the lower default risks comparing with the non-investment grade bond. Because of the lower default risks, then this kind of the investment grade bond offer the investor the lower yield return as well. Then issuer may, right? Issuer is mean that the corporate, for example, the Siam Cement, the Advanced Info, CP, right, Asian Property, that are I name for example of the issuer. The issuer may pay a lower interest rate or the lower coupon payment compared to the non-investment grade bond or the non-investment grade issuer. Here you are in terms of the non-investment grade bond. The non-investment grade bond. The other word of the non-investment grade bond, you can call here this kind of the bond as the high yield bond or junk bond. So what it is, the non-investment grade bond or the high yield bond or the junk bond. So this kind of the bond issued by company with lower credit rating compared with the investment grade bond. What is the lower credit rating as the non-investment grade bond? Please notice here that please do memorize that the credit rating double B and lower. For example, double B plus, double B minus, right here. This is the non-investment grade bond. So because of the like a non-investment grade bond, this bond are the higher, contain the higher default risks. Because of the higher default risks, the issuer, right? The issuer will offer the investor the higher yield comparing with the investment grade bond, right? Then the non-investment grade bond, right? The issuer may pay need to pay the higher interest rate or the higher coupon payment in order to compensate the additional risks to the investor. So here on this slide, right? On this slide, I provide you the credit rating of the corporate bond. From your left hand side, that is the investment grade bond, from the triple B minus until triple A. But on your right hand side, that is the non-investment grade bond. The other word of the non-investment grade bond, you can call here like a high yield bond or the junk bond. So the credit rating of the non-investment grade bond might be double B, right? Double B until like any credit rating. So here in terms of the bond, right? I already give you the idea in terms of the bond based on the credit rating. So for the second type, right? How to categorize the bond based on the interest payment. So here in this case, there are the zero coupon bond, right? There are zero coupon bond. And the second one should be the fixed rate bond. And the third one should be the floating rate bond. Here, what is the zero coupon bond? So the zero coupon bond is the bond that issued at the discount and repay, right? Repay at the face value on the maturity. Then during the period, right? During the holding period, the zero coupon bond will pay nothing, will not pay any coupon. Then you will get the principal, you will get the face value at the maturity date. So here for the second type of the bond, right? For the second type of the bond. So this is the fixed rate bond. What is the fixed rate bond? Fixed rate bond will pay the constant interest or the constant coupon rate throughout their term. It might be for 3 years, 5 years, or 10 years. And the third one, right? And the third one, the floating rate bond. What is the floating rate bond? So the floating rate bond, right, will pay the variable interest rate that adjusts periodically based on the benchmark. For example, of the benchmark is the SOFR. What is the SOFR? SOFR is the floating rate, right? The benchmark of the floating rate. SOFR is stand for, I give you here, like a SOFR is the secure overnight financing rate. So I already complete in terms of the bond, like based on the interest payment. So for the third type, we can categorize the bond based on the convertible and option. So I will introduce you the basic concept of the bond based on the convertible and the option. First one, the convertible bond. The second one is the callable bond. What is the convertible bond? So the convertible bond is a kind of the bond that investor can convert the bond into stock equity. And the second type of the bond based on the convertible that we call callable bond. What is the callable bond? Right here, the callable bond is a kind of the bond that investor can redeem or sell the bond to the issuer before the maturity date. So here, in terms of the convertible bond, I give you, for example, that you are an investor, right? Invest a convertible bond issued by Siam Cement Public Company Limited, for example. The face value here is the 1,000 Thai baht. The coupon payment, right? The SEC, the Siam Cement pay the coupon, annual interest payment at 4%. The maturity date is the 5 years. The conversion rate is the 25. So what does it mean? It means that, right, the bond can convert into 25 share, and the stock price, right, and the stock price that is maybe at the time that the convertible bond issue is the 30 Thai baht per share. So here in this case, the convertible bond. So in terms of the convertible bond, the holder, I mean the investor, they have two options. Option one, the investor hold the bond until the maturity and receive the interest payment until the maturity date. Or in terms of the convertible bond, right? The investor have the option number 2, that the investor can convert, right? The investor can convert the convertible bond into share, right? And then sell that share in the stock exchange in order to get profit, right? Earn profit from that when they convert the bond into the common stock equity. So in this case, the scenario 1, if the stock price is the 28 Thai baht, so stock price 28 Thai baht lower than issue price, right? The issue price that I mentioned is the 30 baht, right? 30 Thai baht. The conversion value is the 25, right? 25 share multiplied by 28 Thai baht. If the investor convert this convertible bond into stock and sell the stock in the stock exchange of Thailand, they will get just only 700 Thai baht, right? But your investment, you pay 1,000 Thai baht. So you have the idea what are the decisions. The investor should not convert the bond into common stock equity because selling the bond, right, give the better return than convert into the stock. And then for the second, right, for the second scenario, if the stock price increased, right, from 30 Thai baht to 45 Thai baht. So at the time, the stock price is the 45 Thai baht higher than the issue price, right? So the conversion's value is the same. 25 share multiplied by the current price on that day, 45 baht. Then if you convert the convertible bond into common stock equity, right? And you then sell that stock in the stock exchange of Thailand, you will get the money 1,125 Thai baht, right? That is greater than your principal. That is greater than when you pay the money to buy the convertible bond at 1,000 Thai baht, right? So here, based on for the fourth one, right? For the fourth one is the based on the collateral and the security. So may I introduce you to have the idea we can classify the bond by based on the collateral and the security, what it is. First one, right? The first one is the secured bond, and the second one is the unsecured bond, or we can call the unsecured bond as the debenture, right? The debenture. The secured bond, right? May I give you the idea? May I give you the idea what is the secured bond? It's a kind of the bond that have any kind of the asset of the issue back up this bond, right? At the maturity date, in this case, please focus at the first time, the secured bond. At the maturity date, if the issuer cannot return the principal or the interest or the coupon to the investor, the regulator, for example, SEC, right? The SEC will force the issuer sells that asset back, right? In order to raise the money and return the money to the investor, right? So here we call here as the secured bond. And the second type of the bond based on collateral, we call here as the unsecured bond or the debenture, is on the opposite side, right? At the end of the period of the bond, right? If the issuer cannot, right, do not have the money to repay, to return the principal, in this case, all right, the case of debenture, the regulator cannot force the issuer to sell any asset in order to raise the money and return the money to the investor. So because of these leaks, because of the leaks of the unsecured bond or the debenture, normally the unsecured bond or the debenture, the issuer of this kind of bond probably offer a higher yield return in order to compensate, right, the leaks to the investor. And here we go to the last one, the last category of the corporate bond based on the maturity. So in this case, based on the maturity, we probably divided the bond into three period. The short-term bond should be the time to maturity should be more than 1 year to not more than 3 years. Medium-term bond, the maturity should be more than 3 years to not more than 10 years. And for the long-term bond, right, for the long-term bond, the time to maturity or the maturity date of this bond, the long-term year should be more than 10 years. So here we already complete the type of bond. So for now, we move to the benefit of the investing in the fixed income security. In terms of the benefit of the fixed income security. The fixed income security, such as money market, short-term bond, government bond, corporate bond, right, can offer higher return compared to the bank deposit compared to the bank deposit. As the nature of the fixed income security, they pay here at the second bullet point that they pay the consistent and predictable income. If you compare the fixed income security, these instruments are safer than investing in the equity, in the stock equity as the third bullet point, right? And having fixed income in the portfolio as the bullet point number 4, right? Having the fixed income in your portfolio can reduce risks instead of investing 100% in the stock equity. As well, for the last bullet point, the benefit of investing in fixed income security, because fixed income security can be traded in the secondary market as well. So here, right, in terms of the bond versus the stock, right, on this slide, I provide you the comparisons between investing in fixed income security and common stock equity. So here for the last one, right, I think like I should be for the last topic of the fixed income security of the PowerPoint 9.1 should be the topic of the risks related to fixed income investment. There are 4 common risks related, right? There are 4 common risks related investing in fixed income security. That are first one, default risks. Second one, interest rate risks. Third one, marketability risks. And the fourth one, the last one, is the reinvestment rate risks. What it is? Okay, let's see. The first one, default risks. What is default risks? Default risks refer to the possibility that the issuer are unable to pay the coupon and principal on time, that we call default risks. The second type of the risks, the second risk is the interest rate risk, right? Interest rate risk is when the interest rate increase will affect the bond price, right? As you know, as you have the idea on this page, on this slide, that in order, right, in this case, right, the relationship between, right, the relationship between interest rate and bond price. Here interest rate and here is the bond price, right? Please notice here that the relationship between interest rate and bond price is the inverse relationship. What does it mean? In this case, please notice, right? Please follow me here. That if the interest rate increase, right, in this case on the slide number 48, if the interest rate increase and the bond price will decrease, will be decreased, right? So please follow me. Imagine that if you buy a bond at par, 1,000 Thai baht, right? Then the interest rate increased. So you probably get lost if you want that bond in the market, because the bond price at the time will less than 1,000 Thai baht. Here on the opposite side of the interest rate affects to bond price. In this case, please focus on the interest rate on the opposite side here, right? If the interest rate decrease, the bond price will be increased, right? As the inverse relationship. So here, go to the third list of the fixed income security. So here we call marketability risks. In terms of the marketability risks, some kind of the corporate bond, for example, the lower grade corporate bond, do not trade in an active secondary market. That kind of bond contain the marketability risks. Imagine that if you hold a lower quality bond, you probably cannot sell that bond in the secondary market. Therefore, the marketability risks refer to the difficulty of selling a bond in the secondary market. Last one, right? Last one is the reinvestment rate risk. What it is? If you hold a bond at a higher coupon, for example, 7%, unfortunately, the interest rate decreased from like a 7% to 5%. During the period, you get the coupon payment, right? The coupon payment at 7%. But you cannot reinvest the money that you get from the coupon payment at the same rate, 7%, because at that time, the market rate is just only 5%. Then you will you face with the reinvestment rate risk if you invest in some kind of the fixed income, and at the time when you get the coupon, and at the time the interest rate decrease. So that's all, right? I would love to introduce you to have the idea of the fixed income security.